Welcome, everybody. Good morning. We're going to give a couple seconds for everybody to join. My name is Carolina Rozewski, and I am the Community Development Officer at Peapack-Gladstone Bank. I have 10 years of banking experience in the mortgage processing, and now I'm in compliance. And I am here today with my partner, Amaro Pereira. Would you like to introduce yourself?
Sure. Thank you, Carolina, and good morning, everyone. Happy Thursday, and hope you are enjoying your summer. My name is Amaro Pereira. I've been with Peapack-Gladstone Bank for about 8 years and in the mortgage banking industry for 30. We are very excited you have joined us this morning for this important webinar. The process of purchasing homes seems intimidating, but with guidance, home buying should be exciting. Today, we will cover the home process from pre-qualification to closing. Once again, thank you so much for joining us, and let's begin.
All righty. Thank you, Amaro. So a little bit about our organization. Peapack-Gladstone Bank was founded in 1921, and we have about 17 branches in Somerset, Hunterdon, Morris, and Union counties, and its headquarters is in Bedminster. Our foundation is built in 5 core principles: professionalism, we compete to win, we are one team, our clients come first, and we invest in our community and pride ourselves on the depth of our relationship with our clients. All right, without any further ado, let's start with what is considered when applying for a mortgage. And I just want to let you all know that we will have a time for Q&A at the end of our presentation, so just prepare any questions that you guys have. So the first thing that lenders consider is your credit score, which has a big impact on your closing costs, your PMI, which is private mortgage insurance, your mortgage payment, and your homeowner's insurance rate. Amaro, can you tell us a little bit more what PMI is, or private mortgage insurance?
Sure. Private mortgage insurance, also called PMI, is an insurance taken out by the lender on your behalf on mostly conventional loans with less than 20% down payment. The insurance is paid by the borrower, and premiums will depend on down payment and also credit scores. The insurance is taken out for a number of years until you get your 20 or 25% equity. Once you do reach that equity, you may write to your lender and ask them to remove the insurance.
Great, thank you, Amaro. So like Amaro said, lenders also look at the down payment, which is 20%, is the standard to avoid PMI on conventional mortgages. However, our affordable mortgage programs have different down payment standards, and Amaro will go over them a little bit later in our presentation. So lenders also look at your employment history, at least 2 years history of employment. Lenders also look at what your income is and your debt to income ratio. So that is what your income is in comparison to what your monthly debts are. So since your credit is a very important part of buying a home, you should get a copy of your credit report and check your credit every year. You can go to annualcreditreport.com. It is the truly free site mandated by the federal government. You can have access to all 3 credit reporting agencies: Experian, Equifax, and TransUnion. If there is anything incorrect, you can dispute it right online on their website. It is important to stay on top of it to watch for any fraud or identity theft. Most mortgage programs have credit score requirements. Lenders look at your credit score and determine the risk in lending you money. So the higher the score, the lower the risk for the bank. So we pull all 3 credit reporting agencies and we go by the middle score. So for example, if you have a 725 with Equifax, and a 716 with TransUnion, and a 769 with Experian, then we will go with 725, and that is the standard in the mortgage industry. Okay, so once you have been pre-qualified, found the house of your dreams, you have an offer accepted, the attorney will draft the sales contract. Don't forget, it is also important to perform a home inspection during this time. You will put a down payment, usually within 10 days of signing a contract, which will be held in attorney escrow. And you will begin the application process with the financial institution. These are some of the required documents that you need to have ready when applying for a mortgage. Amaro, can you please go over the required documentation?
Sure. So now, congratulations, the fun begins, right? You have an accepted offer, and most lenders will require the following documents when applying for a mortgage. It is important that you provide as much as you can up front, so there are no surprises later in the process. So you want to make sure that the questions, or if there are issues, you want to know them up front, that instead of later on in the process. So most lenders will request 2 years of tax returns, which pretty much gives the bank an idea of exactly all of your income, not only the income that you receive from your employer, but also income that you may receive from outside of your regular job, whether it's dividend and interest. You may have a second job, you may be self-employed, have a small business. It will give us basically an idea of what your total income is. So we'll give us a history of all your income in the tax return. We will require the 2 years W-2s. This is the little paper you could receive at the end of the year or at the beginning of the year to file your tax returns. This is coming from your employer. 1 month of pay stubs. So if you get paid every 2 weeks, we will require 2 pay stubs. If you get paid weekly, we will require 4, and so forth. So if you get paid monthly, we would just require 1. Then we go into the asset side. We require 2 months of bank statements for all accounts, whether it's checking, savings, 401k, and investments. This is one of the components of the process that first-time homebuyers usually make some mistakes. And this is not done on purpose. It's just basically just they don't have the knowledge, and that's through deposits. So the first thing, you're thinking about buying a home and you have some cash or someone owes you any money, the first thing you do is you deposit in the bank. And that's a no-no, because we will go back 2 months to look at your statements and your activity. And if we see deposits outside of your regular paychecks, monthly paychecks, we are going to question them. And if you don't have proof of where this money came from, we will not give you credit for that amount. So it's very important that it is okay to make the deposits as long as you have proof of where it's coming from. So if a friend owes you money, or if you sold a car, it's okay as long as you documented the trail. We will require your copy of your driver's license. Obviously, the sales contract has been approved by your attorney. It's signed by the seller. It's also signed by you, and so forth. And then for self-employed borrowers, we require the last 2 years tax returns, your personal tax returns, and also the most recent year-to-date profit and loss, along with the business returns. So we want to make sure that how the business is doing, how you get paid, if there are losses, and so forth. So that pretty much sums it up. But again, it's important that once you are thinking of start to purchase a home, whether it's 6 months or a year from now, that you start a good record keeping these documents handy. So when you present to the lender, whether it's at the pre-approval beginning of the pre-approval or at the mortgage process, you basically show them everything about your finances and also about your your assets and your credit, so forth.
All right, thank you, Amaro. So then this is where we begin the mortgage process. So once you have submitted the application and all required documentation that Amaro mentioned to your financial institution, this is also when your loan officer can lock in the interest rate. This rate is good for generally 45 to 60 days. So you have 45 to 60 days to close on your mortgage. Your interest rate, your APR, which is the annual percentage rate, and an estimated closing cost will all be disclosed to you 3 days after you have submitted your application. This is called the loan estimate. You should read and sign every page where signatures are required. And if you have any questions about the loan estimate, you can contact your loan officer or the processor who is assisting you in processing your mortgage. So the loan processor is usually the one who orders the appraisal and gathers some more information if needed. And while the mortgage is being processed, you should get a quote for homeowners insurance. Once the appraisal has been done and most of the required documents have been submitted by you, the loan then goes to the underwriter, who will review all your information and make the final decision. After the loan is approved by the underwriter, then the loan is set up for closing. Right before closing, your financial institution will contact your employer about 5 days prior to closing to verify that you're still employed. And a credit report will also be run again to ensure you did not acquire any additional debt during the mortgage process. This credit update will not affect your credit score, but during this process, it's very important to make sure you continue to pay everything on time and not change anything. So once everything is scheduled with your closing attorney, you do the final walkthrough of the house. And at the closing table, you must bring the additional money you need for the transaction, and your attorney will let you know a few days before your closing exactly how much you need to bring. Then you will sign the note, the mortgage, and the closing disclosures that constitute the final list of all the fees that you must pay. And we also like to tell first-time home buyers to think about what it is that they can afford for a mortgage payment. So for example, the mortgage payment is $1,500 and your current rent is $1,000. So we encourage you to put the extra $500 in a savings account and don't touch it for a while to see what it feels like to be responsible for the extra $500 payment. So now Amaro is going to go over the do's and the don'ts.
Thank you, Carolina. And just adding to what Carolina was talking about, your mortgage payment, there are a lot of times where the lender will tell you that, hey, you can afford X amount of dollars. Just because the lender tells you that you can afford this home or afford this payment, it doesn't mean that you are comfortable with. So you want to make sure that, one, you are comfortable with the payment, like Carolina's mentioning, from going from a rental payment to a mortgage. Because outside of that mortgage payment, remember, we're using a percentage of your gross income. And, the bottom line is when you get your net income, and that's basically the money you have available for that month. You also have other expenses outside of your mortgage. You have utilities, you have, car insurance, cell phone, and so forth. So it's very important to, get your finances in order and make a budget and make sure that even though the lender may tell you that you can afford this property, but at the end of the day, you're the one that's going to make the payment, and you have to be comfortable with it. So on the do's and don'ts, this is very important, especially for first-time home buyers. Again, we do this on a daily basis, so a lot of times we take it for granted. But being a first-time home buyer, or this is one of the largest purchases that you'll make, or sometimes the only purchase you make in your lifetime as far as a home. You want to make sure you get pre-approved or pre-qualified, because the last thing you want it to happen is you go out and see a property which you really like, and then you find out that you can't afford it. One, it's either over your budget, or the lender will not approve you for that type of mortgage. So you want to make sure you know beforehand what is your purchasing power, so there are no surprises. With today's economy, usually the real estate agents that you work with, or even if you buy a house for sell by owner, they want to see a pre-approval, that you've been pre-approved even before they show you the home. So again, it's very important to get pre-approved up front and know your credit and so forth. And work with a professional, home buying professional, not only with a real estate agent, because a lot of times you can purchase a home through the owner, but once you are interested in a property, reach out to a home inspector and make them part of your team. Same way as the lender. We the lender, the realtor, your attorney, the home inspector, we're all part of the same team, and we're all working for the same goal. The ultimate goal is to to assist you with your journey to becoming a homeowner. We talked about credit. Make sure you understand your credit. Once you apply for the pre-approval or pre-qualification, the lender's going to run your credit, and they're going to go over the credit with you. Not so much the credit score, but also what's in your credit. There are programs that have a specific credit score that they need, but we also look at the overall credit, how you repay your bills. I've seen so many times where someone has a great credit score, but they don't pay their bills on time, and vice versa. So we're not only looking at the credit score, but your entire picture of your credit report, which tells us a lot about how you are going to repay that mortgage. Have a savings plan. So when you start thinking about purchasing a home, with every paycheck, if you're set up a goal, whether it's $10,000 or $20,000 that you want to put down payment, set up a goal and put a little bit of every paycheck aside towards your goal until you meet that goal. And that also gives you a comfort level that you're able to save money while you're still paying rent, or once you get your mortgage, that you're able to still put money aside. Having a paper trail for again, this is one of the most important and I see that a lot of first-time home buyers make the mistake, is again, because they're not aware that they just can't just go to the bank and put a $5,000 deposit or $7,000 deposit. So as I mentioned before, it's okay to make these deposits as long as you have a trail. Whether if your parents give you a gift and they just give you a check for $10,000, it's okay to deposit that check as long as we get a letter from your parents that you are getting a gift. So that as long as we can trace it, then we can give you credit. If we can't trace the assets, what it means that we're not going to count that towards your closing costs or down payment, it means that you'll need to show us more assets in order to make the transaction. Keeping your job and your income, steady. We've had situations where, if it comes a time that you have to change jobs, it's okay, as long as you stay in the same line of work and your income stays stable or is pretty much the same. But the key thing is here, just, let your lender know as soon as you switch jobs. If it's during the process, let them know that, hey, I've switched jobs, because we're going to need to verify that you are working. Even if you start the new job a couple weeks before closing, just let the lender know, and they will do a verification either through a letter that they sent out, a pay stub, and so forth. Again, keep good records. Once you begin the process, or even thinking about purchasing a home, whether it's 3, 6 months or 9 months out, start gathering these documents, start looking at your credit to make sure that if there are, you'd be surprised, companies put in, a $50 collection account and you don't even know about it because you haven't seen your credit in a while. So it's important to, to see that up front, and, keeping copies of your, any deposits you make, your pay stubs, and so forth. And then again, ask a lot of questions. This is, like I said before, this is a large purchase, and we do it every day. So, sometimes we don't expect some of the questions that are asked. But in this case, if there's something that you don't understand, ask the lender, ask your attorney. The lender sends you documents to sign, and somehow doesn't look right, or you don't understand, just don't be afraid to ask the questions. And keep the lines of communication open. Again, if throughout the process, if you are something changes, just let the lender know, and your attorney know, and so forth. Now the don'ts. As we mentioned before, don't go out shopping for a house without knowing what you can afford. Like I said before, that's something that you don't want to be surprised that you love a house and then you can't afford it. You're not, as I mentioned before, you're not alone in this process. Your team will be your lender, your attorney, your home inspector, your real estate agent. They're all working with you along the way. Closing and opening accounts with your creditor on your credit. Again, lines of communication, keep them open with your lenders, and hey, I'm thinking about closing this account. Should I do it before closing? Or I'm thinking about opening an account. What should I do? Like making major purchase. I see a lot of homeowners, they're ready to close, and all of a sudden they start going out to the furniture store and purchasing furniture and outside furniture and so forth, which is, it's an exciting time. You should not be going out and buying a car or a boat during that time, especially if you're making this large purchase. But again, if you do need to make that purchase, it's okay, as long as you let the lender know that, hey, I'm buying a car, or I'm purchasing this furniture, and my monthly payment is going to be X. Do I still qualify? And as long as you can still qualify, then there's not an issue, because we will pull what we call a soft credit report just before closing. Your score won't get affected, but we will find out if you open new accounts, or if your balances went higher, or if the lender asks you to keep a zero balance because you can't afford the payment. They will see that in your credit report, that the balance went higher, or you open a new account. Again, don't make any large deposits like we spoke about before. other than your paycheck. If your deposits are $3,000, $4,000, $5,000 a month, and every month you make those type of deposits, then the lender's not going to question. But if your deposits are basic, your paycheck, whatever it is, and all of a sudden you make, just before you are looking to purchase the home, you make a larger deposit, then we're going to ask where the money came from. And as I mentioned before, if you make any changes to your job, just make sure that you let the lender know. And at the end of the day, as long as you keep the lines of communication open with the lender, we are here to assist you and make this process less stressful. And it should be an exciting time when you're first buy your first home. Next slide, please. So there are different types of mortgages. The most common ones are your conventional fixed rate mortgages and adjustable rate mortgage. So your fixed rate mortgage is basically a mortgage where an interest rate remains the same for the entire of your loan. The terms, you can get anywhere from a 10-year fix, 15, 20, or 30-year, where the interest rate is the same. Your principal and interest payment is always going to be the same. But don't confuse it where a lot of times people said, hey, I have a fixed rate loan. My payment is never going to change. It can change based on your property taxes or your homeowner's insurance. What does not change is your payment, the principal and interest, and that's always fixed for the remaining of the term. On the adjustable rate side, I don't advise first-time home buyers to get these type of mortgages because they usually give you a lower rate at the beginning of the term, whether you get a 3-year, there are 3-year, 5, 7, and 10 years. And what the adjustable rate mortgage means is the rate is fixed for that term. So let's say, example, you get a 7-year adjustable rate mortgage. It's still based on 30 years. So your payment is still based on the 30-year amortization, but the rate is only fixed for the first 7 years. So if you think that, hey, in 3, 4, 5 years, the rates are going to drop, I'm going to do a 7-year adjustable because then I'm going to refinance. But what happens if the rates don't drop? Now, all of a sudden, after the seventh year, now your rate can go for, I don't know, let's say you start out at 7%, your rate can go as high as 9%, and your payments will continue to go higher. And you may not, may not be part of your budget. So it's very important to, especially in the first-time home buyer, try to stick to your the fixed rate where you know exactly what your payment is every month. Outside of the increase or decrease in tax or insurance, you pretty much know for the rest of the loan term what your payment's going to be. Next slide, please. So here at Peapack, we're going to go over a couple of the mortgage products that we offer. One is your conventional mortgage. All right, it's basically your standard. We do purchase or refinancing. So this could be if you're purchasing your first home, or you can buy a second home or an investment property, or refinance your existing home. When it comes to refinancing, when you first get your home, if you get a higher rate and then mortgage rates drop, you could always refinance. There's no prepayment penalty. So you could take a loan out for a 30-year fix and you're in there for a year and all of a sudden rates drop 2 or 3%, you're able to remortgage and, and get a better, lower down payment. Lower monthly payment. On single-family homes, the minimum down payment is 3% of the purchase price or the property value, whichever is less. So again, single-family condos, and you must live in the property. On two-family homes, the 15% down payment is required, and then 3 to 4 family homes, if you are trying to purchase a multifamily, you only go to 80% of the purchase price. If you own a home and you want to buy an investment property, 1 through 4 units, 25% down is the minimum for a conventional loan. Private mortgage insurance is required where less than 20% down payment on these mortgages. We do offer another type of mortgage that doesn't require, which I will go over that shortly. And again, there's no cost for us to get a pre-approval, pre-qual. So, we run your credit. And like I said, it's important before you go out, house shopping, that we can pre-qualify you. The mortgage approvals are pretty quick, and we'll make sure that once you sign that contract and there's a closing date in your contract, we make sure we try to get your closing on time. Next slide, please. So our next program is our PGB affordable housing program. This is basically geared towards first-time home buyers although this program is not, you don't have to be a first-time home buyer, but you must occupy the property. So for example, if you had a home and you sold it, and you purchased another home for you to live in, you can still apply for this program. It is a program that is restricted in certain counties and in the state and income. So we offer this program in our assessment area, which is in Essex, Hudson, Hunter, Middlesex, Morris, Somerset, and Union counties. We do allow grants. So if you are getting a grant, whether it's through us or through a housing agency or a state, as long as it's a nonprofit organization, we will allow that grant to be applied towards your down payment or closing costs. Mortgage insurance is not required in this program. Again, this is a big savings. You don't have to pay the insurance, even though you're not putting down 20%. Owner-occupied properties only. We do not accept co-signers that are not going to occupy the property. So if you're purchasing a home and you need a co-signer, whether it's your parent or a sibling, this program will not, be applied to you. Minimum score is 660 credit score, and with a 620 credit score with PMI. So meaning that if you came to us and you said, hey, I have a 630 credit score, am I eligible for this program? We would be able to do the same program, but with a private mortgage insurance, because there's more risk to the bank with a credit, and we will take out an insurance policy for that. On one and two units, the minimum down payment is 5% down. So again, this is a great program. You can get in with 5% down and not pay the private mortgage insurance. Out of the 5%, 3% must be from your own funds, meaning that you have to invest at least 3% towards the transaction, whether it's down payment or for closing costs. So, and then everything else could be a gift. So if you're getting a gift from your parents, as long as you have 3% of your own funds, then we will count the other assets towards your down payment closing costs. We also do on 3 to 4 units. So if you're inner cities that have 3 to 4 units where you collect rents, we also allow that to be part of this program with 10% down payment. And a home buyer education is required. Basically, you'll sit down with a loan counselor to go over all your budgets and making sure that you are ready to become a homeowner. And again, it's not just about making your mortgage payment, but the responsibility that comes with it, keeping your credit and so forth. There are income limits for this program. So in Somerset, Hunter, and Middlesex, the max income is 102,640. Morris, Union, and Essex, 93,520. And Hudson County is 79,200. So this is the max that household income. So if you make above this income, then you will not be able to apply for this program. We do offer higher income limits if the property falls into a low to mod census tract, as well as the over 50% majority minority. Next slide, please. The Affordable Home Buyer Dream grant, it's basically the same program as I just went over, or affordable. The only difference is that this program we will provide a grant up to $10,000, where if you are eligible, it's a $9,500 grant towards your closing costs and down payment, and also we will pay you $500 towards the certified agency to do the home buyer education course. There are a couple different criteria as far as the eligibility. The education is required. And the difference between this program and the one I just spoke about are affordable, where the affordable we could only do it in certain counties. This particular program, it's available into the entire state of New Jersey. Same thing, 5% down payment is required, 3% of your own funds, and no mortgage insurance is required, and owner-occupied 1 through 4 family properties only. At this time, we're in July, we are out of grants. We get anywhere from 10 to 20 grants a year, and once we're out, then we wait a couple months until they, if they offer us any more from the Federal Bank Reserve. So, like I said, at this time we don't have any of these grants, but we are looking to get some more. Next slide, please.
Okay, we are at the end of our presentation. Thank you so much, Amaro. And I think, Marcela, we are ready for our poll question, and we would like everybody to participate and answer. So the question is, what is one of the primary reasons borrowers get declined for a mortgage? So number one is credit, low FICO score, insufficient credit, excessive debt, unacceptable property, employment history. So I'm giving a couple more seconds for everybody to participate and respond. Okay. All right. It looks like we have 96% for credit, low FICO score, insufficient credit, excessive debt, and 4% for employment history. Amaro, what do you think about this answer?
Got a smart audience. I mean, all three could be a reason to, you know, for a borrower to be declined, but the most important is credit. You know, if you have good credit, like I said, a lot of the programs require 3% down payment as long as you know your credit score is there and your repayment, the way you repay your bills. But on the contrary, you could have a large down payment, great income, and then if your credit doesn't meet the criteria, there's a really good reason that that loan could be declined based on credit, even though, you know, we have borrowers that put down 30, 40, 50%, and they can't understand why they're being declined because, you know, they just don't pay their bills. So yeah, very smart audience. Good job.
Okay, we're gonna see if we have any other questions. Okay, here is one. Amaro, can I purchase my first home with a co-signer?
The answer is yes. There are some programs that will allow, like I think I mentioned before, like in our particular affordable programs, we do not allow co-signers. So if you are looking to purchase a property and let's say, again, your parents are willing to co-sign because it's your first home, the conventional programs, which are your standard mortgages, will allow you to have a co-signer as long as you put 20% down payment. So if you put less than 20% down, there are some programs throughout the backed by the federal government, the FHA, that will allow a non-occupant co-borrow. But like I said, for the most part, conventional loans, they will require 20% if you have a co-signer that's not going to occupy the property.
Okay, thank you. Let's see if we have any other questions. Okay, here's one. What if I don't have a 2 years employment history because I just graduated college?
That's a great question. That's okay. You know, as long as we're looking for a 2-year history, whether it's education or employment. So if you just graduated college and, you know, we will require a copy of your diploma, and also you're now employed. So we will take your current income as long as it's a steady base income. For example, if you start up a business, that's going to be an issue because we usually like to go back 2 years to get an idea of what your income is going to be. But if you're just a regular base pay W-2 type of employee, we will take your income, even if you just started a job and you usually have an offer letter from your employer. We will take that and also a copy of your diploma and use that as a history. So yes, you can purchase a home with less than 2 years.
Okay. All right. Any other questions? Okay, so we don't have any more questions at this time. I would like to thank everyone for joining. And oh, wait, hold on a second. It looks like there is one. Hold on, sorry about that. Okay, so here we go. So if my partners put a home under my name, do I still have the benefits a first-time home buyer receives?
If a partner puts their name on the home, or
so if my partner put a home under my name, do I still have the benefits of a first-time home buyer?
But first-time home buyer is classified as someone that has not owned a home in the last 3 years. That's basically the definition of a first-time home buyer in our mortgage world. But like I mentioned before, and under our program, you don't have to be a first-time home buyer. You just have to occupy the property to take advantage of that program. But if you have a home where you live and then you're trying to purchase another home as an investment, then that would not be considered a first-time home buyer.
Okay. Any more questions? That was a great one. All right, it looks like that was it for today. Again, thank you so much for joining. And you will all receive a replay of this webinar for your records. And Amaro, anything else to say?
That pretty much sums it up. Again, thank you so much for joining us. We hope you enjoyed it. We hope you can take some knowledge from today's webinar and apply it. Again, it could be a very stressful process, but we are here to make sure that you're on the right track. As far as from the from Peapack, we are here to assist you in any way we can. We're not a transaction, meaning that we just don't want to do your mortgage. We want to be your relationship lender, banker, whether it's a checking account, student loan, whatever it is. We want to take that journey with you. And again, thank you for joining us, and enjoy the rest of your summer.
Yes, and our contact information is there. So if you have any questions, our email address, our phone number, and Amaro speaks Portuguese and Spanish, and I speak Spanish too, just in case anybody needs assistance. All right, thank you all and have a great day.